right, it looks like we've got a quorum here, so we'll go ahead and kick things off. Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's webinar. We're going to try to unpack the latest developments in terms of AI with DeepSeek being announced very recently, and also Stargate from OpenAI, Oracle, SoftBank, and others, and try to really do the read across into energy markets, power demand, and industrial equipment suppliers, and how you can think about these latest developments and how they could play out for a number of the companies that are affected. So on the call to do that today, we've got numerous folks from the BI team. So we've got Mustafa Okur joining, Omid Vaziri joining, Scott Levine joining, and Nikki Su. Just quickly, if you don't know Bloomberg Intelligence, I'll note that we have about 400 plus analysts at this point. We cover 135 industries. If you missed it earlier today, our colleagues on the tech team did a webinar focused on this same topic, but looking at the big hyperscalers and how to think about this latest development for the likes of NVIDIA, Meta, Microsoft on down the line. But for today's conversation here, we're going to be focused on the energy impacts. And so I'm going to kick things off and just quickly, we've seen an emerging trend here in the US of increasing power demand. And I think there's a few pillars to that narrative. It's not just the AI story, but AI is a big piece of it. We're seeing vehicle electrification, a resurgence of manufacturing in the US. Part of that resurgence is driven by things like the CHIPS Act, the Inflation Reduction Act. So there is some policy uncertainty, but we've seen this big uptick in investment in manufacturing facilities in the United States. That's what this chart is showing. And AI data centers are also a big pillar of the narrative of what could be happening with power demand. And so we've got really two primary scenarios for thinking about this outcome here in the United States. And so roughly data centers, where we stand today, they're doing about 200 terawatt hours of power demand, power consumption in the US. And we think that could grow to, kind of 400 terawatt hours, 800 terawatt hours by the end of the decade, with continued upward trajectory. But a lot of it really comes down to, well, how much CapEx are the hyperscalers and all the companies building data centers really going to spend? And what's the efficiency of all the processes that they're engaged in? So you've got the efficiency of the chips themselves, you've got the efficiency of the algorithms. I think DeepSeek really layers in this idea that maybe all of this can be done more cheaply with less compute. So maybe if the DeepSeek world really unfolds as something folks think it is, maybe we're on the lower end of the trajectory we show here on the screen. If the OpenAI and all the data centers that are being built out there and the CapEx numbers are real, and you really do need all of this compute, and then you need all of the data centers to help give folks the ability to ask the AI's queries and whatnot. Maybe we're on the top end of the trajectory. I was certainly very skeptical of the notion when I saw Sam Altman and some of the other AI stalwarts talking about this idea that data centers and AI could consume, upwards of 20% of US electricity demand. But you really could get into that kind of territory, particularly on the upper end of the range for where we think things could go. And so clearly, I think there's a lot of uncertainty. And when you look at the market reaction to some of the DeepSeek news, there's almost this sense that, well, maybe there is going to be less energy used to help facilitate this AI world. I still think the best way to probably frame this problem is to think about it from a scenario framework. And so, maybe on the low end, you're going to see power demand from data centers grow up 4x versus the 2023 level, or maybe it's more like 10x. And so I think that's the crux of the debate. And I think the team here is really well positioned to help us think through what that build out looks like and how the companies could be affected. And so with that, I'm going to turn it over to my colleague Mustafa to continue the discussion here.
Thank you, Rob. So this is Mustafa Okur. I focus on US industrials with a heavy focus in electrical equipment. So companies like Vertiv, Eaton, Amphenol, and nVent. Basically, before we sort of dive into the coverage, I wanted to give everyone some sort of a framework to dwell on how to think about the impact from both Stargate, but more recently and more so from DeepSeek. So if DeepSeek models breakthroughs in terms of improving efficiency substantially for training and inference of these LLMs is true, and they can be adopted by tech companies, then how should we think about what happens to demand for data center infrastructure equipment, and what happens to the energy complex, starting from all the way from Nikki's companies, utilities, the grid, and all the way into the building. So the main question to answer here is, will the need for power-hungry GPUs fade if training and inference requires less compute than previously thought? Now, you could just say no. This is a Chinese innovation, nothing to do with the US closed source AI models, but I'd be very cautious to take that view because DeepSeek has open sourced their papers for their V3 and R1 models. So it's very hard to argue that there will be no change to tech capex. You could say no because of tech competition and Stargate, right? So if Microsoft were to take their foot off the pedal and order less chips, secure less land, fewer licenses, secure less energy deals, Google would step in or Meta would step in to fill the void, and then Microsoft would fall behind. I think that argument does have some merit to it. You could go to the opposite end and then say, yes, there will definitely be a lower power consumption demand, but it is important to sort of differentiate between price and units here, at least for our coverage. So if Microsoft goes to NVIDIA and negotiates a lower price for their future chips, then the units do stay the same or maybe even go up. The power consumption maybe goes up, so maybe the demand doesn't change. But if the units do come down, then there could be lower demand. So that is one potential outcome. And then we sort of start to get into the maybe territory of, potentially in the near term, there is some sort of uncertainty. The demand does come down. The spending from tech companies do come down. But we do have Jevons paradox in economics, which is as the unit price of something comes down, there are more units consumed and overall consumption goes up. And we are seeing this in the GPUs themselves. From Hopper to Blackwell, 40% more compute for around the same wattage, and the tech companies are ordering more and more chips to train ever more capable models. And last, but maybe not least, maybe there's a focus on better ROI by the tech companies, but look, these companies want to solve things like curing cancer with AI, attaining AGI, I don't know, discovering an Alcubierre drive to warp space, right? Whatever trillion-dollar problem they want to solve, and they will try to probably get as many chips as possible in their hands to do that. So that is another potential outcome. So, having said all that, we probably land somewhere in this maybe zone with some sort of uncertainty in the near term. Now, if we were to look at the spending by these tech companies, it goes from an average of 10% capex to revenue to 20%. So there is good reason to be a little bit skeptical about the growth targets of some of these companies. We have on the left, up left of the slide here, direct exposure to data center spending, Vertiv leading at 80%, followed by companies like Amphenol, nVent, Eaton. And we did a scenario, sort of scenario analysis for Vertiv only today, looking at hyperscale spending halving, but then inference spending going up, so more local enterprise spending, but that could still create maybe a 200 BIP headwind for their growth rates. And if you could argue that local inference doesn't go up as much, that headwind could be potentially stronger. Last but not least, we have sort of companies with indirect exposure on the right. So big electrical companies like Eaton, but also GE Vernova. It's indirect exposure because their main clients are the utilities and the grid. We think their growth targets for the next 4 or 5 years are relatively safer because the products they sell, they have very, very long shelf life. You could run a GE turbine for a couple of decades before it requires upgrades to extend its life. So the impact from DeepSeek and efficiency gains, we think, is potentially less upside to their targets as opposed to potentially slower growth there. So with that, I will pass the torch to my colleague Omid to talk about Europe and his coverage.
Thank you, Mustafa. I cover European industrials here out of London. I want to start by contextualizing industrials' key challenge here. So enthusiasm for AI and tech investments, including those in power, have overshadowed concerns that an economic slowdown or geopolitical risks, may hit industrials' earnings this year. The excitement has made the focus more longer term, even if market uncertainty, even if there's some market uncertainty this year, and we're seeing that Investor Day presentations have jumped on the trend, and this has also influenced returns through late 23, 24. Now, many of the share prices of sector peers, likes of Schneider, ABB, Legrand, reflect AI enthusiasm. Those with high data center exposure, great exposure, like Schneider and ABB. So it's not surprising that how investor understanding of the sustainability of AI-driven earnings develops could be key to industrial 2025 performance. And we had a real good glimpse of this in yesterday's market reaction to the DeepSeek breakthrough. The sector's challenge this year is to maintain earnings momentum to justify valuations. European large electrical companies' valuations are way above historical averages, as you see in the chart, with Schneider most reliant on tech spending. This might help explain yesterday's market reaction with share prices now back at pre-Stargate project announcement levels last week, but not much below December levels. Industrials like Schneider, as I mentioned, Legrand, ABB, but also Siemens, they enable AI and cloud by supporting data centers and electrical grid with power supplies, cooling equipment, switch gears, transfer switches, transformers, as well as software. And if you go to the next slide, here are some of the some of these products as we see them inside the data centers. And the slide shows company sales exposure. These are data center sales only. So percentage of data center sales exposed to each of these product categories within the data center space. And on the left, you have towards the top the key company sales exposure to data center market, and towards the bottom you have a market outlook growth for physical infrastructure equipment. Now, these companies' data center sales, generated from products linked to power-hungry GPUs and complex data centers like liquid cooling and very high-capacity UPS solutions, could see lower than anticipated demand growth over the medium term. If DeepSeek's LLM model has proved training and inference can be done using a fraction of the GPUs compared to US LLMs. If you don't need as much GPU clusters and power needs of distributed clusters are a lot more manageable, this reduces the need for liquid cooling. However, under a different scenario, the overall data center market demand outlook could remain as strong or even get a leg up if competition among hyperscalers intensifies as a result of this breakthrough, or if the lower cost of model drives democratization of use and potential shift to edge data centers with demand from enterprise also rising rapidly there. New applications made possible could drive wider wider scale inference require more compute and power consumption, positive for equipment demand ultimately. We also see a scenario where order intakes take an initial hit as focus shifts to prioritizing return on investment before recovering again on model advances, AI model advances that require greater compute power, which ultimately will be needed. In any case, we think DeepSeek's low-priced open source model might not affect 2025 capital spending for cloud infrastructure providers, given the backlogs. If anything, could increase enterprise adoption if the cost curve of large language models falls sharply. And a long-term pickup in businesses AI usage could in turn drive usage of cloud and hence data center physical infra demand. Could stay resilient as a result. Now, tech companies may be reluctant to lower investment given competition for more capable models. But another scenario to consider here would be that more floor space is allocated to IT equipment, with overall power consumption lower than estimates. On the whole, electrical infrastructure and data center markets are likely to remain key growth drivers for the industrials, we think, where competition could still intensify and consolidation still likely in fragmented markets, even if midterm sales growth from data center market gets tweaked, depending on scenario outcome. As for Siemens Energy, I think it needs to be looked through at a different lens. Rising demand for gas turbines and grid investments can still continue, and these comfortably outweigh any change in AI-related exposure there. In fact, companies' medium-term profit and cash flow growth prospects through 2028 just got a lift after the pre-release of its fiscal first quarter results last night, showing strong beats across orders, 7% beat profit, 18% beat and cash flow. And this is being led by not just electrification demand, but improving order backlog profitability. And the Stargate project in the US could see demand for gas-fired electricity generation pick up if plans for very large data centers go ahead. Siemens Energy lifted free cash flow pre-tax annual guidance to above €1 billion from up to €1 billion after it generated €1.5 billion in 1Q alone when we had the numbers last night. And we're expecting a big raise in cash flow guidance with the fiscal first half release now. Companies valued on medium-term profit growth prospects, not this year's earnings. So I think that's worthy of note. Moving on to the final slide. If we consider the impact of those names in our coverage that supply equipment to the semi industry, demand for VAT Group's vacuum valves and Atlas Copco's pumps used in semiconductor manufacturing could in fact get a boost if DeepSeek's lower cost large language model generates Gen AI adoption, accelerates Gen AI adoption, with increasingly smaller computers able to run it, which will be positive for a chip making equipment demand recovery. Competition among hyperscalers is likely to remain strong, supporting the semi-capex recovery narrative for 2025. And we see appetite for leading edge chips unlikely to be significantly disrupted because scalable AI models gain an edge, gain an edge from greater computing power. So we see that continuing. As low-cost models drive broader adoption, AI inference chip demand could also ramp up, again, positive. We have a focus ID on the VAT Group, where we see sales expanding at a CAGR 20% out to 27, driving 9% upside to consensus EBITDA, likely to be driven by a potential to outperform the 8% CAGR in leading-edge wafer fab equipment spending, with mid-single-digit CAGR support from both market share gains and expansion in different adjacent businesses by the business. These together drive about 150 growth in EBITDA through 2027 in that scenario, and we're holding on to that. So I think this is a good place for me to stop and pass it on to Scott, who will talk about the impact on power infrastructure.
Thanks, Omid. So I cover energy and industrial services, including the infrastructure construction companies. I'm going to talk about two things here today. Number one, I'm going to revisit our power construction model, which leverages Rob's numbers, which you discussed at the outset, to try to estimate how much additional power capacity will need to be built in order to support growth in AI computing. And then secondly, I'm going to talk about the moves in the stocks yesterday and try to frame that from a valuation perspective for some of the infrastructure services companies that will be instrumental in the power infrastructure build out. And so what we have here on this slide is a model that we built that, again, leverages the numbers at the outset and assumes, we assume a 4 to 10 times increase in the need for power to support AI computing. This estimates how much additional capacity would need to be built, measured by gigawatts. And if we assume the bear case here of a 4 times increase in AI power usage in the US alone, we're talking about 275 million megawatt hours of additional power needed. That would require about 100 gigawatts of additional capacity. And that would equate to nearly a 10% increase in the US power base. That assumes a 30% capacity factor, or estimates of the amount of uptime for the reactors, and that varies by fuel type, and I'll get to that on the next slide here. So you're talking about a pretty substantial number here, even if we're looking at the bear case, which, again, I'm not a technology expert, so it's tough for me to opine on the implications of DeepSeek here. But if we assume, I think, the conservative end of the range, we're talking about the 9% increase in power capacity, and assuming $1,000 per kilowatt, which is about on average with the construction cost for gas and utility scale renewables, you're talking about $100 billion in incremental capex. The bull case, as you can see on the far right there, would be 3 times that in terms of the power gen capex, and 3 times that in terms of the gigawatts needed to support growth in AI. So even at the lower end of the range, we're talking about pretty heady numbers here. The next slide here goes through the various fuel types, and we do think in all of the above, with the possible exception of coal here in the US, would likely be required to meet these power requirements. Again, the pros and cons vary by fuel type pretty markedly. I think the greatest uncertainty is obviously on the nuclear, particularly for baseload, as we've only had 1 plant built in the US in the last 3 decades, and that ended up coming in at close to $14,000 per kilowatt. You can see the costs of nuclear dwarf those construction costs anyway of other fuel types. However, nuclear plants generally make that up in terms of the operating cost efficiencies, at least on paper, and I think in reality as well. But there's still a lot of uncertainty in the outlook for nuclear, and we've done some recent work on that that's available on the terminal. Small modular, I think, is the focus. And again, the appeal for nuclear for the hyperscalers, again, number one, it runs 24/7, it's baseload power, and B, it's emission free. 2 things that appeal greatly to the hyperscalers. But our base case, I'll just throw out there in terms of timeframes here, which is also an important factor, is that we may not see nuclear plants in service, including small modular nuclear plants, which we think will be favored for their flexibility. We're talking potentially the middle of the next decade before those in service. Only one design has been approved by the regulators, and none of them have been built yet. So we're talking 2035 is kind of a reasonable guidepost for timing there. For gas, combined cycle gas, beginning to end, you're looking, I think, at probably close to 2030. Chevron came out with an announcement this morning saying they thought they could get a plant in service with engine number 1 and GE Vernova by the end of Trump's term. But I think 2030 is maybe a reasonable time frame to think about there, and wind and solar obviously much shorter in terms of the time frame for implementations. But just to give you some sense in terms of the timeline to build the type of capacity we talked about on the prior slide. Lastly, I want to frame the stock moves here and also discuss valuation. So this slide shows Quanta and MasTec, which are two of the big infrastructure service companies, and they, along with Fluor, were off 15 to 20% yesterday. Just to give you a sense. But those are big drops in stocks that have done very, very well. And frankly, it was a bit eye-opening to see what the impacts on the valuations were, when looking at this through a more of a historical lens. And while we saw Quanta, which is the largest infrastructure services contractor, specialty contractor in the market, was off maybe a full turn yesterday on an 18% move down, and MasTec was off close to 2, or actually the reverse. Quanta was off 2 turns, MasTec off 1 turn. To get back to historical averages on these stocks, and particularly for Quanta, for example, you'd still be looking at another 30% downside to get to the historical average trailing 12-month EV to EBITDA multiple, which is in the mid to high teens versus the 22.5 times multiple you're looking at on the chart here, even with the pullback. So substantial moves up in these stocks, discounting some pretty heady growth expectations that we're looking at. And obviously it's up to investors to determine whether that's reasonable or not. But I'll leave it there and I'll turn it over to Nikki to talk more about the utility perspective.
Thank you, Scott. Good morning, everyone. Thanks for joining us. Like Rob mentioned, it's too early to know which power consumption scenarios is going to play out. But one thing is certain, data centers are not the only demand drivers. Power consumption from electrification and manufacturing onshoring will certainly drive significant demand for the sector. Low growth will be uneven among different regions. Estimates from competitive markets like ERCOT are seeing a 6-year CAGR of 9% through 2030 and 6% through 2034, while PJM is lower at 3% and 5%. And most of the integrated utilities in regulated market are guiding 1 to 3% in the next 3 to 5 years. But even if we only realize half of the forecast, it's still going to require significant capital spending in capacity and transmission, and likely driving up power prices. The question is what's priced into the market right now? Stock performance before the DeepSeek announcement seems to suggest that the 3 IPPs, Vistra, Constellation, and NRG, along with 3 utilities, Entergy, PSEG, and NiSource, have seen the biggest gains in the 12 months, fueled by the AI frenzy, while the rest of the utilities have not participated in the AI hype, likely because regulators may limit their profit and customer bill remain a major hurdle. Based on Scott's base case scenario of 200 gigawatt capacity for the AI demand, we estimate it could be up to a 5% CAGR in bill increase. So the returns for most of the utilities in the past 12 months are largely driven by the declining interest rates and supported by the overall low growth outlook. For PSEG here, the outsized return is because investors are pricing in potential nuclear data center contracts for its 3 merchant nuclear power plants, and Entergy signed a deal with Mega already. And for NiSource, there are reports that Microsoft might be interested in building data centers in its service territory. So yesterday's sell-off seems to reflect the same view we had earlier. Other than the 6 names that we mentioned and the California utilities, the rest of the S&P 500 utilities outperform the broader market. So the 3 IPPs are going to be very volatile going forward, moving with the AI demand outlook. And merchant nuclear generators are likely to be the most volatile because of the expectations of about market contract with data centers. We still believe there will be more contracts signed at premiums for nuclear power plants given the limited supply out there. while regulated utilities, with the exception of PSEG we talked about earlier, are likely to be less affected because so far it doesn't look like investors are pricing in too much of the AI demand lift. I think most of utilities forecast that 1, 2, 3 load growth forecasts out there are relatively conservative compared to some of the forecasts you have seen out there, because utilities usually will contemplate the more the visibility. If they sign the contract, they will include it, and or if they have the visibility of the potential demand, they usually do not put out something that they don't have a good visibility into the future. Rob?
Thank you, Nikki. So with that, we are going to move to Q&A. So if you have any questions, if you could type them into the chat, we'll try to get to them with our remaining time. So a couple of just easy comments quickly here. One is that the slides are going to be available, and we'll make sure to redistribute those to everyone who has joined today. The second thing that I would highlight is that we have some cool modeling tools to help you think through this problem. So we had that projection for US power demand from data centers, and we kind of tackled that problem from two ways. I'll just try to give a really interesting sort of high-level take on it. Right now, for every $1 billion of CapEx that the hyperscalers are spending, we think it translates into about 0.4 terawatt hours of electricity demand. So if you build the $500 billion Stargate initiative that was talked about, you get something like 200 terawatt hours of electricity demand. But we make that framework available where we take in the expected CapEx numbers that our tech team run by Mandeep Singh, Anurag Rana have come up with, and we feed those into our model to sort of think through how power demand could be affected by all of those CapEx numbers. So if you think the DeepSeek is going to really change the amount of CapEx required, you can go put in your own CapEx numbers, or you could toy with the amount of power demand that results from each incremental dollar of CapEx. I would also note that Mustafa here on the call did a completely opposite approach, where he said, hey, let's look at how many NVIDIA GPUs are going to be sold, how much power does each one consume, and also back into what an implied power demand number is. So we've got a bottom-up approach where we do look at the GPU power consumption, or we've got more of a macro top-down approach. Very fun. The last thing that I would just highlight is that you can access these models, or you can access our reports by typing BI Deep on your Bloomberg Terminal. And there you can find our deep dive on this topic, but also several deep dives that our tech team has written on this topic. And our industrials team also has a deep dive that is in the works on this topic, which will be out very, very soon from my understanding. So make sure you check out BI Deep. Make sure you check out our models, because we're happy to have you get your eyes on them and give us feedback, and let us know if you have any comments on those. But okay, so with that, I'm going to ask some questions. So the first one that comes to mind for me is the scuttlebutt seems to be that that maybe DeepSeek had access to a lot more GPUs than was initially implied by the cost estimate that they provided. And so I want to maybe just quickly do a round robin here, and because this all really translates into what kind of revenue and growth trajectories many of the companies that we cover you'd be thinking through. So, what's your sense? How secure is the expected revenue and earnings growth for your companies in 2025? And is all of that baked in, even if DeepSeek is real? So Mustafa, let's come to you. 2025, how much does DeepSeek really affect things, whether it's true or not? And if you have any commentary on whether you think it's true or not that they actually did it for such low cost. I'm curious.
Sure. 2025 earnings, bottom line, probably close to zero because a lot of the revenue, probably around 80% for a company like Vertiv, is already in the backlog. So the commitments are in place, the buildings are going up, the cooling systems, the UPSs, the switchgear will be delivered. So we're not worried about 2025. The worry is more about what happens in 2026, 2027, and probably more about beyond. And the issue is these companies, some of these companies have given out targets to 2029, including Vertiv. So what happens to those growth rates? And they are pretty lofty growth rates, right? So saying 12 to 14% revenue CAGR in the next 5 years. So what happens to that number is the question here. And to be honest with you, without really knowing how many GPUs that DeepSeek has used, we don't really know, right? So I'll be honest there. But it seems like they have made some breakthroughs in the algorithm. So they are using a different algorithm compared to the closed source models. They have made some breakthroughs in pre-training and post-training, and also in inference. So they're doing something called multi-token prediction, for example, rather than just predicting the next token. And these were sort of verified by, I would call, industry stalwarts, like people like Andrej Karpathy, who are like one of the pioneers of LLMs, right? So if he's saying some of these gains are legit, then I would take his word for it. So to sum it up, the main question is what happens to the next GPU design, right? Or what happens to the attitude of companies like Microsoft, OpenAI? Will they go to NVIDIA and say, we want a price cut, we want fewer units? So that's the overhang.
Thanks, Mustafa. Umid, I want to probe a little bit on this as well, just and maybe frame it from a sort of transatlantic divide. My sense is that a lot of the investment has been very US focused, and I imagine some of your companies are somewhat geared towards the US, but are you seeing this kind of investment in Europe as well? And kind of what's your read into the safety of revenue growth and earnings growth from the European segment?
Yeah, so the key market is the US for the European industrials, the likes of Schneider, Siemens, ABB, and Legrand. Europe, we're seeing good growth in the UK, in the Nordics because of the temperature, cooler, but also availability of hydropower, which is cleaner source of energy. Spain, we're seeing some good number of data centers being built out there again because of the availability of more cleaner sources of energy down there. And but most of the growth and the focus is really most of the demand is coming from the US market midterm. Now, we take the view that hyperscalers likely continue to pursue best-in-class data center facilities in the near term. And the 2025 CapEx, which, by the way, likes of Microsoft have just recently set about 2 weeks ago, is unlikely to take a hit. So we're probably okay for 25 and maybe some good part of 26. But if we have CapEx slowing in 2026, it would clearly the first impact would be on the GPU side and the power usage as a result. If you don't need as much clusters, power needs of distributed clusters, maybe a larger number of smaller clusters are a lot more manageable. And this could reduce the need for liquid cooling, for example. Now, amongst our coverage, Schneider and Legrand have decent exposure to liquid cooling. Siemens and ABB don't. They don't have it in the portfolio. They partner with other providers to provide it. So they're a little bit, I guess, immune from such development. Schneider recently went out and acquired a 75% interest in a company called Motivair, and it paid $150 million for it. This was in sort of late 2024. So that's quite that's quite a move. And now, if we see the case for liquid cooling less strong, that might explain why we've seen the share price reaction for Schneider yesterday. But in any case, we think, like Mustafa said, I would echo his comments here, that this is more of a 26 and beyond type consideration. The main risks could be in the very kind of high spec, high capacity, uninterruptible power supplies, where, by the way, ABB and Siemens are also greatly present. If the overall power usage is by the data center, or the power need is said to be not as much as initially thought.
Thanks, Omid. Scott, I want to bring you back into the conversation. You mentioned nuclear briefly, and when you look at how the tech industry talks about this topic, they often talk about the need for a breakthrough in energy and power, and there is a flurry of activity related to SMR, small modular reactors out there. But I would note that NuScale had a pullback yesterday, along with a lot of the other names that we've discussed here. But, you know, given that nuclear has such a long time horizon, you know, how do you think the nuclear exposed companies are planning? Does DeepSeek matter? Is it still full steam ahead for those guys? How would you frame nuclear?
Yeah, good question. And I just want to clarify in response to one question in the Q&A box. It should be megawatt hours in terms of the incremental growth in the model on our slide there. To be clear, that supports the 9 to 25% increase in power demand that we see. So I just wanted to clarify that. With regard to nuclear, it is, historically been a very long cycle business, right? And so you have a number of small modular nuclear companies out there trying to develop novel technologies, and all of them are effectively in the development stage. And so you really have to take with a grain of salt. These are almost like the highest beta plays on this AI power theme, right? Whether it's NuScale or Oklo or Nano or the private companies. Bill Gates is supporting one, and Sam Altman is the chairman of another. These are all speculative, right? They all have novel technologies that have, with the exception of NuScale, have not been licensed by the NRC. And so NuScale actually was developing its first commercial project and canceled it last year because they were experiencing massive cost overruns. The projected cost had more than tripled, and the project was canceled because they couldn't get customer subscriptions to buy the electricity. And so really what we've seen that gives us confidence that it's going to move forward, I think, has given investors confidence, as well as the fact that hyperscalers have announced agreements effectively to support the development of these technologies. Now, how ironclad those are is, up for question. Not very is the answer, but Google has announced an agreement with Kairos Power to develop a number of small modular reactors with them. Presumably the understanding at the very earliest they're in service by 2030, and that's the very earliest. And that's against a track record with limited information, and again, only one full-size build within the last 3 decades. But the announcement in and of itself suggests that the hyperscalers are believers in the technology, even if it's got a long development timeline. Again, we said 2035 is a base case, maybe 2030 as an aggressive case to develop these technologies. But the one thing I think we can, and I should mention as well, that some of the manufacturers of the legacy full-size reactors, including GE Hitachi and Westinghouse Electric, are developing small modular reactors. So we do think the next wave of builds will likely be small modular. However, there is very little known at this point, and none are in commercial service. So you have to take the projections, I think, with a grain of salt. But I think we do have confidence that they will happen in some way, shape, or form.
Okay, let's keep the conversation centered on nuclear here for a second. In addition to the SMR story, there are a number of announcements here in the last year related to restart of nuclear facilities. So 3 Mile Island comes to mind. I think NextEra just started talking the other day about restarting a facility in Iowa. There's an uncompleted nuclear reactor in South Carolina, the Santee Cooper one, that they're talking about revisiting that and seeing if they can get that one started. So, Nikki, I want to probe you a little bit on the conventional nuclear side of the equation, because that does seem to be folding well into this theme. Give us a sense, how quickly could 3 Mile Island get restarted, or any of these others? And, is this really something we're going to see more of, or if we kind of hit the end of that runway for now?
So far, there are 3 merchant nuclear plants that are in the process of being restarting. In addition, like VC Summers, there are 2 reactors. They are actually regulated nuclear power plants. So I believe Sandy Cooper is trying to look for buyers to complete the project. But either way, no matter, I don't believe the reactors would actually come online in this decade at all, because it takes years to complete this project. But let's focus on the 3 announcements for the restarting. Palisade in Michigan is likely to come online later this year. So that will be the first one. 3 Mile Island and Dwayne Arnold, both Constellation and NextEra are targeting 2028. Based on NextEra's note, they mentioned that the biggest damage to the power plant is the cooling tower, and it's a very limited, it's a low risk construction. So, and 3 Mile Island, obviously, Constellation give a very detailed timeline. They seem to be confident in the timeline. So we'll see. But the first one we'll see will be Palisade this year. Other than that, if we look across the entire US, there's likely not going to be material addition to new nuclear power plants other than the restart. It will be the 3 restart. I think it's about 2.3 gigawatt. And then there are some smaller capacity addition from the upgrade to the existing power plants. And those are not going to be alive, probably between 1 to less than 2 gigawatts. So very likely the capacity increase until we get SMR, it will probably just be limited to probably 4 gigawatt. And that's less than 4% of the total capacity right now.
Yeah, thanks, Nikki.
Yeah.
Quick advertisement. If anyone listening, if you enjoy this kind of discussion, we hold a call every Wednesday at 10 a.m. that goes into our research, really kind of unpacking the latest developments and energy markets, electricity markets, these kinds of things. So reach out to myself or anyone on the call if you want to join that. I know Mustafa and Omid do a similar call for the industrial sector. And we also have active chat rooms where, news happens and you can participate and talk to each other. We weigh in as well. So if you want to be in those chats or you want to participate in those calls, please do reach out to any one of us and we'll help you get that sorted. Nikki, I have a follow-up. One thing that comes to mind is, I think it's unusual perhaps, or sort of unprecedented in the last decade plus, to be really thinking about utilities as sort of a growth segment, right? And I'm curious to get your read on whether there are better markets to grow in. Is ERCOT a faster growth market because it's just easier to get things done there? Because my sense, if you listen to the folks in the tech industry, they want to move fast. They don't want to wait in long interconnection queues. And so given that speed is a priority for them, where can they go and get the power most quickly to connect their data centers to? Can you give us just a sense of, where is it easiest to build stuff?
Yeah, you're definitely right on in this perspective. say, for example, in PJM, we've seen there's the regulatory challenges on the talent and Talent's nuclear contract, right? But in ERCOT, because it's not regulated by the FERC, so it's easier to move ahead, and they have their interconnection queue obviously shorter as well. So obviously you definitely have a point, like it depends on which market. And that's why the expectation out there is if you want to get the contract done sooner and get interconnection, ERCOT might be a better location than PJM. And the other thing with ERCOT is that it also has a good balance of the regulatory requirement and the demand, right? Because population growth is really high. So that area, like I mentioned before, their estimates is more than double what PJM is saying, right? And then in the integrated market, you also have to go through the entire regulatory process. On top of it, there are concerns about reliability and then customer bill increases. So overall, it seems like the regulated competitive markets probably would be easier, and ERCOT is probably going to face less regulatory hurdles than PJM.
Very interesting, Nikki. And I think historically there's a lot of internet backbone kind of in the DC, Northern Virginia area. So kind of shifting to Texas is a little bit of a sort of change in sort of probably the data center infrastructure side of the equation, but maybe they'll have to do it for power reasons. Okay, so I want to just hit on this last topic that's on my mind, and some of you have asked questions along these lines as well. So President Trump in remarks, I think he was speaking to the World Economic Forum the other day and mentioned that if companies were wanting to build power plants to build these data centers, I think he had the Stargate initiative in mind, that he would sort of issue permits to get the power plants built, so that the U.S. company, the idea would be that he would sort of wave a wand and help the U.S. companies move more quickly. We'll see whether he can deliver on that process. Maybe he's got some mind to really ease the burden on NEPA permitting, things like that. But I want to get a sense, and we're going to go around the group here. So, I don't think that China is nearly as constrained in terms of their ability to move quickly, get power plants built, whether it's, solar, wind, gas, coal, just on nuclear down the line. You're just seeing a rapid build out of power capacity still in China. And so, Mustafa, when you think about your companies, given that you can seemingly move more quickly in China on some angles of this general theme, are companies in your remit looking to China as a growth opportunity, or are they really placing all of their bets within the West, the US, Europe, that sort of thing?
So because of the primarily US domicile of my coverage, a lot of them are more geared naturally, geographically to the US, but it's not like they're shunning China completely. And Eaton, for example, a few years ago made several moves with JVs, because that's how you do business, mostly in China, to be able to supply a broader portfolio of uninterruptible power supplies, the key equipment in data centers. So they have made moves to do that. When companies talk about the demand from China, they do sort of tend to tie it with general economic growth as opposed to AI. So maybe that story hasn't come to fruition yet in China yet. Perhaps the DeepSeek models change that. We'll see what happens once companies start giving guidance this year, I guess. but it hasn't been a needle mover, let's say, for my coverage, at least yet. Having said all that, I think ownership and data security and having sort of autonomy over your AI models will be a key sort of power or bargaining chip in the future, or like a tool that you cannot miss in your arsenal, right? So it will be part of the future in that sense. So I think everyone will catch up to the US over time. And I agree fully that you can move more quickly in China if the government wants you to, right? So yes.
Omid, let's move to you. Kind of same question, and I'm curious how you'd frame it against Europe, because I think there are some regulations and some proposals in Europe to build data centers there. I know the UK just put out a AI data center framework or plan the other day, but give us a sense, are your companies really just primarily focused on US, Europe, or is China part of the perspective that you should be thinking about for them?
I think China is part of the perspective, so is Asia ex-China. I mean, UK classifies data centers as critical infrastructure, so that just shows you how important they think it is. And I think for national security, it is an important step to make now. Assuming AI training and the needs will continue after the DeepSeek breakthrough, I think AI training is likely to move to new markets, like you say, Rob, with more power availability, as power supply in traditional data center markets could struggle to keep up with demand. And this is what Trump's trying to alleviate, some of these challenges. China, in my view, could continue to be the laggard here, despite some growth catch-up. Near term, it's hampered by local economic uncertainty, but also tougher government regulation on internet companies, and you have U.S. trade restrictions on high-end semiconductors. So that does pose some restrictions for it. So growth in Asia ex-China could be higher, and European companies like ABB and Schneider, they're global in nature, and they are positioning themselves very much for the Asian markets.
Thank you, Scott. Over to you. Same question. How are you thinking about the names in your space, and are any of them geared to China and around this theme at all?
Yeah. The short answer is no. Unlike oil and gas, which is really a global market for the infrastructure construction companies, electric power is predominantly a domestic market. I think you have to be familiar with the regulators, and the regulators need to be familiar with you. I think that's even more so the case with China. They tend to use local labor to build all of their facilities, to an even greater extent than other countries. And so Quanta and Moztec, the companies we referenced here today, are strictly North American, or almost entirely North America in terms of the focus there. And they build not only power generation, but also electric grid. So I think because of the regulatory framework and the importance of it, and nuclear, I would say in particular, that's the case. There's even more sensitivity to the regulatory and safety requirements that are imposed by the local regulators, that it tends to be a domestic market from an infrastructure services perspective.
Nikki, tell me, we'll come to you. I think this is an easy question for you, but I know some of the European utilities are active in the U.S., but for the moment here, are most of the U.S. utilities domestically focused, or do any of them have sort of broader global ambitions here at the moment?
Yeah. So you are right. U.S. utilities are predominantly domestic operations only. In the S&P 500 utilities, only AES has overseas operations, so the exposure is almost not there. Yeah.
Okay, thank you, Nikki. All right, so I think this is really, we've hit the end of our time, and we want to be respectful to everyone. We've already taken an hour here, so I want to thank everyone who joined. We will be following up with an email. Please make sure to check out our deep dives on this topic. If you can't find it, we'll get you pointed in the right direction. Please make sure to leverage us as a resource generally. Again, we have these calls that we do periodically from the various teams. Again, the next one, 10 a.m. tomorrow, is our next energy call. We've got David Bellman joining from a company called SynMax. They use geospatial data to help think about energy markets. We're going to talk about that with him. And then our industrials team has it. We also have chats that allow you to speak not just to us, but with the broader community of terminal users on topics like this. So reach out. We're happy to get you connected to the right place, even if I don't hold the answer. I'll make sure we get you where you need to be. So right now, we're all green dots on the terminal. Shoot us an IB if you have a question, or pop us an email, and we'll get back to you as soon as we can. Thank you so much for your time, and we appreciate all of your interest in this very exciting topic. Take care, everyone.